I'd like to thank everybody for joining me today. Today, I want to talk about how we handle positioning assets and diversifying assets, not just for risk, but how do we justify this in a way to reduce our future income taxes? If you start looking at this, think about this in buckets. I'm visual, so I like looking at it this way. So if I'm looking at these buckets, well, during our working years, we're going to be bringing in income, whether it's payroll, getting our paycheck, getting business income. All of that money comes in taxable. And if we look at that, we have that money in the working years. Then we have that money that we're putting away for retirement. And as we're putting that away for retirement, you know, the default is let me put it in a 401k, let me put it in some kind of an IRA, whatever those qualified plan opportunities are. But as we do that, remember, most of that is just deferred income that's going to be taxable. And finally, the third bucket is what if? As we're putting money away, what if we need it between now and when we retire? Or is this money that we're going to need in retirement? How much, when? That's why it's what if. We don't know if we're going to spend it, and we don't know in what amount we're going to spend it. But if you start looking at all of these buckets, we've got a tax problem. These buckets get taxed in a very specific way. And as I look at this, think about this, and they're again thinking of visual. Most people are on a track that they're taxable and they pay as they go. They don't realize that there's other tax planning strategies that are out there. But now they're only giving one other option. And it's like, okay, let's take that retirement money and let's tax defer it. And I look at it, when you tax defer it, just remember, for every dollar that you have in that qualified plan, it's not yours. Maybe, 70, 80% of that is yours, could be less. But Uncle Sam is there as a partner, and Uncle Sam gets paid every single time you access that qualified plan money in retirement. And Uncle Sam likes getting paid. And so Uncle Sam says, great, we're not going to let you touch this money until you're 59 and a half. And if you do, we're going to have you pay the tax plus pay a 10% penalty. Well, that can't be the what if money. And I remember in 2008, as the markets were dropping, people were scrambling for cash. And I saw a lot of people that didn't have that what if bucket full of accessible money. It was in their retirement account. So it's great. Things are bad. So now you get to pay a bigger tax bill. Or I see a lot of clients that go into retirement and they did a great job saving. And now that's one, they don't need that extra money. But Uncle Sam says, hey, I'm your partner and I want paid. So I'm going to hit you with required minimum distributions that say I get my money. Well, let's remember there's a third track, and that is tax-free. Tax-free. We don't ever have to pay tax again on that money. And as we start looking at that, there's ways to do this. We can use Roth accounts. We can use cash value designed life insurance policies. These are great assets because they fill a what if bucket. They also fill a tax-free bucket. So if we don't use that money, it's going to pass on to our heirs tax-free and creates that nice bucket. So the question I always like to look at, can we reposition our assets so that we can get a better alignment in our buckets, and also a better tax future for us so that we're paying less tax in the future? So as you start looking at this, let's look at this and reposition it into life insurance. And life insurance, I think, comes with some extra bonuses in the fact that we can get on that tax-free track. We can access the money when we need to. But it also is one, if we don't use it, we can pass on that tax-free death benefit to our heirs. So as I look at this, what I'm looking at here, and when I talk about repositioning assets, let's reposition either assets that are underperforming assets that are just sitting there and creating a current tax problem. And I see this with a lot of clients, especially with that what if. I need to have liquid money available for that what if scenario. So they have money sitting in a CD, they have money sitting in a savings or investment account. They're not planning on using that money, but it's sitting there as what if. Well, think about that. That's good money to look at. Can we reposition into the tax-free bucket? So when we look at that life insurance, we're going to figure out what the right premium is. And as we're pulling money from that account, we can do it in a single payment, we can do it in multiple payments. Got to be careful if we're looking at this as a tax-free bucket. Most likely we want to use multiple premium payments, not a single payment, because that would create a bigger death benefit and could create problems to access that policy. When we're designing that policy, every life insurance has a death benefit. Now we look at this and say, we're repositioning these assets so that our client during life can access this money. So we want to look at cash value. We want to make sure that that is a minimum death benefit, maximum cash value growth. So we want to get as close to the modified endowment contract line as possible without passing it. So we've got access to that policy. And this creates that nice what if bucket of money. We can access those cash values during lifetime tax-free anytime we want to, or don't access it during your lifetime if you don't ever need it. If you don't, it's going to pass on as a death benefit. The other what if that I like to ask clients, do they need to cover some long-term care? And this life insurance policy, if we want to add a long-term care rider, if we want to add a chronic illness rider, that's a nice bonus for the clients that need it, because now they've got access not just to the cash value, but we can accelerate the death benefit tax-free to cover those long-term care bills. There again, nobody wants to pay for long-term care, but if it happens, what if? We've got it covered. Now, if you look at this, we're going to have a death benefit here. Now go back and think about that savings account, that CD that was just sitting there. Well, it might be worth $100,000, $200,000. But now we put it into this life insurance policy, and that death benefit is going to be more. How much more depends on how we design the policy. But there again, we're maximizing what our client can access during life. We're eliminating that tax hit in the future. But then whatever's left can pass income tax-free, and if we want estate tax-free to our heirs as that death benefit that is going to be more than what we had in that underperforming asset. Now, I look at this and everybody looks at this and says, well, this sounds great, but I'm too old. Well, let's look at an example here. Here we have a male age 73, healthy. And there again, age 73, most clients think they've passed up the opportunity here to reposition this. When I look at this policy, we're going to design this to put in $75,000 a year for 6 years. So he's got an underperforming asset. He wants to get it into a better tax position. But let's focus on the what if. What if he needs the money? And that net surrender value, if I look at this policy, he's going to put in $450,000 over a 6-year period. And if I look at year 10, he's got $527,000 of available money that he can borrow. If he doesn't touch it at age 88, there's $723,000. If he were to pass away, he's got a $583,000, almost $584,000 death benefit that will pass income tax-free to his heirs. And we'll see in the later years, if he's not using the money, that death benefit grows. And we can see that this cash value and this death benefit is going to continue to grow until he needs the money. If he needs the money, or if he doesn't need the money. If he needs the money, he can get it tax-free. If he doesn't use it, it's going to pass on tax-free to his heirs. So it's a good opportunity to help our clients position themselves to fill in those buckets as they need to tax, money they need now, money they need in retirement, money that is just what if, but also to move over and get onto that tax-free train and get on that track so that in the future, we've eliminated those future taxes and our client can access the money and use it when and if and how they want to. I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.